I currently have 60 open option positions on Tesla. It makes up 92% of my public portfolio, and right before earnings, I decided that I don't have enough Tesla options. I decided on this because A, I'm crazy, and B, I was reading this article on how Bitcoin Optimism offers potential Tesla option trade by RBC. In this video, I'm not only going to go over my current Tesla position, thoughts on Tesla's earnings, but I'm also going to open up a risk reversal trade as RBC recommends for basically $0 and see what happens in episode 3 of trading options to $1 million. In the first episode, I placed 9 different iron condors, which all succeeded, making 12% in just 1 week, which comes out to $351 on a small portfolio of $3,500. And in episode 2, I opened up a Lulu call option, which made 280% in a couple of days for a total of $2,675 on $960 worth of investment. So we are up $3,026 in total. Now, episode 3, I'm going to make a bit more of an expensive trade on Tesla, which I will explain as a risk reversal. But I'll also show you a tiny put credit spread option play. So basically, you smaller portfolio guys and gals, as well as the whales, can benefit with Uncle Henry strategies. I do want to say Tesla isn't necessarily cheap and the stock has run up a whole lot. However, the momentum is very strong, and I pulled my private Discord group and we had mainly bulls in that group. They believe that earnings were going to be positive and the stock was going to go higher. The private Discord group has beat the market 3 months in a row, as large as 7% in the last month, so I trust their opinions and it heavily influenced my already bullish view on Tesla. The only way to get in, by the way, is by submitting an application and watching the training video in the first link. Now, this article says a divergence in options metrics between Bitcoin-linked Tesla and MicroStrategy may present opportunity, according to RBC Capital Markets. Both stocks are up at a time when Bitcoin has gained due to optimism about approval of a US exchange-traded fund, RBC derivative strategist Amy Wu Silverman wrote in a note Saturday. However, the skew measuring the cost of bearish options versus bullish ones is inverted for MicroStrategy, while Tesla is at a very high, she said. To sum up the article and not waste any time here, she suggested a risk reversal trade that involves selling Tesla's 700 puts expiring in December and buying 930 calls. So what I'm going to do is first explain what a risk reversal is and why it's a secret option strategy many don't know about but can be very lucrative. Then I'm going to open a risk reversal trade and see if RBC analysts are as smart as Barkley or Goldman Sachs from episode 1 and in episode 2. I will link both of those episodes in the link in the description. I may even decide that I want to slightly change the strike prices, who knows? So a risk reversal is a hedging strategy that protects a long or short position by using puts and call options. This strategy protects against unfavorable price movements in the underlying position, i.e. Tesla stock for us. If an investor is long a stock, they create a short risk reversal to hedge their position by buying a put option and selling a call option. You can completely hedge or reduce your risk by doing this. When I was an intern for an option trading hedge fund, they use this strategy many times over to hedge their risk. For us, however, we're going to buy a call option, which is going to give us the upside of Tesla stock, but limit our losses to what we pay for the call option. Step 2, now I'm going to pay for that call option by selling a put option to finance that call option. The only risk we will basically have is if Tesla pulls back a lot to our strike price of the put option, in which case I would just have to purchase 100 shares of Tesla. Being that I am 92% in Tesla and most of my wealth, getting 100 more shares would probably be pushing it in terms of risk, but because most people probably don't have a 7-figure portfolio yet, 100 shares is also going to be a decent amount of investment, so this is actually going to be pretty relatable and at the very least super educational what I cover in this video. And as far as a put credit spread for smaller portfolios, let me explain that as well before I jump into my screen. A put spread is an option strategy that is used when the investor expects a moderate rise in the price of the underlying asset, or at the very least not a huge fall down to the strike prices of the first option that they sell closer to the money. Selling put credit spreads is fantastic for smaller accounts and they bring in ridiculous percentage returns, albeit not the largest gross returns. The maximum loss is equal to the difference between the strike prices and the net credit received. So I'll show you exactly what that looks like in just a moment. A put spread consists of two different put options. First, an investor buys one put option and pays a premium. At the same time, the investor sells a second put option with a strike price that is higher than the one that they purchased, receiving a premium for that sale. The amount that you collect or the credit is more than the amount that you pay the debit, so you get to keep the difference. Now let's jump into my screen so I can show you all the different options I have open on Tesla and open up two different positions for you guys. All right guys, let's jump into my screen, and excuse me for the different lighting right now. All right, so I have 8 different strategies going on Tesla. We have a bunch of different options on it. In fact, we have 60 different options. The first one we have is puts. I sold some puts. I have some covered calls. I have some put spreads, which I'm going to be opening in this video. I'm going to be opening up a new different put credit spread because, well, Tesla's stock price has changed. I opened up this put credit spread a while ago. It's actually expiring this week. It's already $3, which means that I've already made most of the money on this put credit spread, which is another reason why I need to open up a new put credit spread. More put credit spreads, some more covered calls, and these are also put credit spreads, but these are more of a leap put credit spread. If I actually click into this, I am up a whole lot of money, up $10,000 on this put credit spread. However, you guys want to see me open up this risk reversal. So let's get into the risk reversal trade right now. I'm going to go into trade Tesla options, and we're going to first go ahead and sell the put option because that's a little bit more important. That option is going to be financing our long call option. So I'm going to go out to December 17th because RBC said go out until December. So this is the only expiration date in December. So let's see what we can make happen. So RBC analyst said 700 put. Okay, we're going to scroll down and we're going to click 700 and we're going to sell this put option right here. Quickly, I want to look at the Greeks. It is a 12 delta and the theta is 0.31, which means that I'm going to be losing about $31 per day in terms of time decay on this option. So I'm going to open up 1248. This is going to be the premium that I collect from opening up this position. 1248 is going to be $1,248. Now, the other thing that I need to do is I need to go buy the call option. So I'm going to buy call and I'm going to scroll up and I'm going to be buying. She said 930, but I kind of see an issue here. Do you guys notice the issue? It's $24.90. It costs $2,490, but I'm only collecting $1,248. So for the people that want to be really bullish and have an option that is near the money, 930 looks fine. However, I did say in this video that I'm going to be opening up a risk reversal trade that is pretty much zero cost. And because I said zero cost, this is not going to cost us nothing. So I need to scroll up. I'm actually going to go up to the 990 call option. Now I can basically open this position for zero cost because if I purchase buy call the 990, it's going to cost $12.70. So right here, I'm going to be paying $12.70. I'm collecting $12.48. So my real cost is only $22 for this option position. So that is a very good cost. And basically, I would need Tesla to go past $990 per share to see some benefit or at least make some money compared to the total cost that I'm paying, which is just $22. That is not likely to happen, but RBC analyst is recommending this, so I might as well open it up and see what happens. All right, so I'm going to click continue right now, and I'm going to place one of these contracts, and I'm going to put 0.24. I'm doing that because I do want to get filled. I want to make sure that I'm not wasting time here. It is going to be a debit. We're going to pay a debit, and I'm going to submit. Typically, I'm not paying debits, but I may have to this time. So $24 is not getting filled, which means that the option traders just want a little bit more money for their hard work. So rather than doing $24, I'm going to put $28 and see if that gets me filled. All right, as I wait for this position to get filled, I'm actually going to go into the put credit spread and open that position up right now as well. All right, guys, so now what I'm going to do is I'm also going to open up a put credit spread. However, this put credit spread is just going to bet on Tesla's earnings. I just want to bet for this week, and I want to see how much money I can collect just for this week on Tesla. So we have the October 22nd right in front of us. I'm going to go sell put. I'm going to go down and try to collect something around a 12 delta or 88% chance of success. That is the sweet spot I go for, because if you go too far out of the money, you will collect very little premium, and it's basically not even worth opening up the position. However, if you go too close to the money, you're adding too much risk to your portfolio, and 30 to 40% of the time you could potentially see a loss, and I do not want to be in that position. For that reason, I go for about 88% success or about a 12 delta, so this should say about 12 or 11. So it says 0.11, which is perfect. That means 90% of the time I will be successful, and I'll just end up collecting the premium and not have any more obligations on that Friday of expiration. So $795 looks good to me. I'm going to click sell, and I'm going to collect $385. Now, with a put credit spread, the beauty of a put credit spread is you only have the amount of risk that is in between the strike prices. So the 795 is one of the strike prices. Now 790 is the other strike price. And in between is just $500. It's $5, but each option is 100 shares. So this is going to be a $500 trade. And because it's going to be a $500 trade, pretty much anyone, even a small portfolio, could execute this trade. However, because I'm closing off that risk, what I do need to do right now is I do need to buy the next leg lower. So we opened up the 795. Now I do need to open up the 790. This is to close off the risk, because even if Tesla stock went down to $0, which is absolutely not going to happen, but if it did, well, the 795 would be down 795, but the 790 would be up 790. So the maximum risk would just be the $5 in between the strike prices. All right, so let's buy this 790. We have $30. $30 might not seem like a lot. It's not the biggest premium in the world. However, someone with a larger account or anyone out there can just open up a couple positions if you wish. You can open up 2 contracts, 3 contracts, 4, 5, or however many you wish to meet the needs of your own portfolio or your own risk appetite. So if I click continue, this $30 actually represents about 6%, and I'll show you guys why it's about 6% right now. So I'm personally going to open up 2 contracts right now. I'm going to put 0.3, and if you guys will notice, it's $60. However, if I go down to the risk, it's not actually $1,000, because the risk is the $1,000 minus the premium that you pay, which is a $60. So the actual max loss is only $940. All right, so I reviewed the order. Now I do want to submit it, and let's see if we can collect $30 or if I'm going to have to wait some time again. Boom, guys, we got filled $60 on $1,000 worth of risk, or really $940 worth of risk. So the actual return I'm going to put on screen right now, but it's going to be over 6%. If you want to see my live trades, my option signals, have access to me, 2 different coaches, a licensed CPA, you can book a free call by submitting an application in the first link below for my private option Discord. Thank you so much for watching. Invest safely, and I love you guys.